When I think about how to position to thrive next year, I have to put my thoughts in context of the current macro backdrop. So while earnings expectations have been moderating in the US and globally, growth expectations still remain relatively robust. Excluding the more rapidly growing IT and comm services sectors, earnings expectations have declined as we move through this year, with year-on-year earnings growth 2024 over 2023 of only 3%. Despite these downward revisions, consensus expectations for next year's growth remain high. Earnings growth is estimated to exceed 10 to 11%. Now, at 22 times next year's lofty estimates and 20 times excluding IT and communication services, US markets are nearly 40% above their long-term averages. It's not to say that we expect multiples to converge to long-term averages in the near term, but it is to say that it is our base case that investors will have a better opportunity to deploy their capital in the coming quarters. So with that as a backdrop, my preferred positioning going into next year would be into defensive equities, which can be done without sacrificing growth, in particular in the utilities sector. I continue to believe that regulated electric utilities are undervaluing not only the growth that lies ahead, given the required electrification of all things, but also the certainty of that growth, given the regulated nature of their businesses. In particular, regulated transmission and distribution can offer high levels of stability, certainty of growth, and generate returns that are agnostic to power prices, as opposed to power generators, which while occasionally hedged, are far more geared to prices. Now, electricity volumes are expected to rise 2% annually after having been flat for nearly 2 decades. And the overall cost to the consumer is expected to be lower than what they currently pay today for energy. So as seen here, estimates are for electricity consumption in California, for example, to nearly double by 2045 to meet climate goals. And growth estimates themselves have nearly doubled over the past 5 years. The conclusion is that in an electrification of everything world, many regulated utilities will be once again growth engines, right? Albeit modest but consistent, which is not priced into certain firms' valuations. Now, our portfolio holding Edison International CEO, Pedro Pizarro, he's viewed as one of the highest quality CEOs in the industry, having been with the firm for over 2 decades. He's a sought-after business leader, recently joined the board of Fortune 100 firm 3M. He's also one of the most forward-thinking utility leaders and recently commissioned an update to the firm's previously published white paper on what will be required to meet California's 2045, now legally codified goals. Now, it's worth studying these as many other jurisdictions are using these goals as a template upon which to base their own roadmaps. So in the study, the requirements to meet these goals are for more than 90% of light and medium-duty trucks, for example, will need to be electric. This is up from 3% and 1% today, respectively. 95% of building appliances will need to be electric, up from slightly more than 10% today. 3 times more utility-scale renewable energy will need to be brought online. And 15% of utility-scale generation will need to come from new or emerging technologies. And then really, finally, and most importantly for how our portfolios are positioned, are that transmission and distribution grid projects will need to be added at 4 and 10 times their respective rates in the coming decades. Now, across the pond in the UK, the energy landscape is undergoing a similar transformation. Climate change and energy security are reshaping policy and driving substantial investments in renewable energy. The UK government's target of net zero emissions by 2050 is supported by Britain's energy security strategy and the UK net zero strategy, both of which view renewables as fundamental to achieving carbon neutrality, energy cost stability, and independence from volatile energy markets. Britain's energy security strategy includes plans to double electricity generation capacity with a focus on renewables, nuclear, and energy storage. And the net zero strategy complements this approach with a structured pathway for sectoral decarbonization, ensuring that interim milestones are met to sustain progress. So given these backdrops, how do we invest? Well, it's clear there will be winners in the new and emerging technology space, be it in hydrogen, batteries, long-term storage, etc. Many of these technologies aren't yet proven at commercial scale. While those that get it right will likely win big, those that don't are as likely to disappear. Both Edison and SSE are positioned in the portion of the transition that will be required regardless of what technologies emerge on the generation or storage side. It is estimated that for California alone, the state's annual 2 gigawatts of transmission infrastructure growth must increase to 7 to 8 gigawatts a year over the next decade. 120 gigawatts of the additional generation required will be by default a near doubling of circuit miles to handle the load. Now, the estimate today for this is to cost $75 billion. Separately, expansion of the distribution system to the end customer will require an additional $50 billion of investment. Now, at present, Edison is trading at 15 times 2025 earnings for 5 to 7% earnings growth out to the end of this decade, and also pays a nearly 4% dividend yield. Now, growth beyond that period will be at least as high, if not higher. It's effectively a low double-digit annualized total return for what is likely to be several decades of growth, trading at a 25 to 30% discount to the S&P. Now, our largest international fund holding, SSE, plays a critical role in the UK's renewable energy expansion by aligning its investments closely with national security goals. Focusing a lot on electricity networks, offshore and onshore wind, hydroelectric power, and emerging green technologies, SSE is really a cornerstone in the UK's energy transition. It's trading at an attractive multiple of 10.5 times earnings, a full standard deviation below its own long-term average, and also offers investors a 3.5% dividend yield and earnings growth of low single digits today, but accelerating to mid-single digits in the coming years. While these are our preferred holdings within the sectors, we would expect well-managed, high-quality utilities in constructive regulatory jurisdictions to have similar tailwinds. So that's certainly my pick for 2025.
Okay, thanks, Brian. I guess one of the questions that springs to mind for me is that many of those types of securities are considered bond proxies. So would they not likely underperform in a scenario where we see inflation and thus interest rates re-accelerating or ticking up again?
Thanks, Linda. That's a great question. Now, often these are considered bond proxies, though I think it's a bit one-sided to look at them as bond proxies alone. So I'm generalizing a bit, but bond cash flows, right, in general, are not growing. They're also not inflation-linked. On the other hand, utility dividends are both growing and inflation-linked. So if you look at regulated utility returns, the returns to investors are determined largely by looking at the company's cost of capital, which includes the cost of debt, and putting an allowable return, right, over and above that cost of capital. So as and when the cost of debt rises, the allowable return will also rise. Now, it is true that there are lags between the time when yields rise and when this translates into the period where the utility can start to charge customers higher prices to compensate for their higher cost of capital. But over time, these mechanisms play out, and utility dividends are protected again against this outcome, and they grow at least in line with inflation, and faster in this case, given the structural growth that I spoke about earlier.
Okay, but now how does this more defensive approach or positioning dovetail with what sounds like quite a pro-cyclical investment view from Ishrith on China?
So to be honest, I don't really look at them, our two views as opposing, where mine is defensive and Ishrith says pro-cyclical. I really categorize kind of my pitch for next year as focusing on defensive growth, but meaning that even in a market that continues to perform well, these utilities will compound at double-digit rates. And similarly, I think Ishrith's discussion around Chinese equities included several items, including fiscal stimulus, for example, that may serve to buoy many of the securities, even in a counter-cyclical way. So ultimately, from a portfolio construction standpoint, I mean, as you know, we don't take binary bets in our portfolios. So these two are largely uncorrelated. They should each deliver double-digit compounded returns next year, and perhaps much more in the case of Ishrith stocks. But I really view them as complementary rather than opposing views.